Welcome to 𝘠𝑚𝑑𝑎𝑟𝑎𝑠A in our today's session. Today, I want us to proceed from where we stopped in our last class. In our last class, we were looking at assets and liabilities, and we have covered a number of aspects of assets and liabilities. And for today, I would like us to proceed on with another aspect of assets and liabilities called impairment of assets. Impairment of assets is covered by a standard we call International Accounting Standard number 36, called IAS number 36. So I want us to start right away by definition of terms. I want us to start right away by definition of terms. Then you write definition of terms. The first terminology is impairment loss. Impairment loss. The first terminology is impairment loss. Then you write below that, impairment loss refers to loss of value of an asset, over and above normal depreciation, full stop. The second terminology is carrying amount. Carrying amount. It simply refers to the net book value of an asset. I.e., that is cost minus accumulated depreciation. The other aspect or the other definition is net realizable value. It is the amount at which an asset is expected to be sold. It is the amount at which an asset is expected to be sold in an open market. I.e., that is selling price of an asset, less any cost incurred to sell. That is the net realizable value. Number 4 is what we call value in use. It is the expected future economic benefits. From an asset from an asset within its useful life, within its useful life. It is the expected future economic benefits expected from an asset within its useful life. Full stop. It is obtained by discounting future cash flows. It is obtained by discounting future cash flows into present cash flows. It is obtained by discounting future cash flows into present cash flows. The fifth definition, recoverable amount. It is recoverable amount. It is the higher of. It is the higher of the net realizable value. The net realizable value and the value in use. And the value in use. And when you're talking of higher, we mean high. So higher. It is the higher of the net realizable value and the value in use of an asset. So you take the net realizable value and the value in use, and you take the value which is higher between the two. Then, after that, you write below that illustration. 𝘬𝘱 Limited acquired an item of equipment. 𝘬𝘱 Limited acquired an item of equipment several years ago. Acquired an item of equipment several years ago. Full stop. The equipment had cost shillings 500,000, and as at 1st January 2021, and as at 1st January 2021, it had accumulated depreciation of 280,000. It had accumulated depreciation of 280,000. Full stop. This equipment was expected. This equipment was expected to generate future cash flows. This equipment was expected to generate future cash flows in the next 4 years of its remaining useful life. Was expected to generate future cash flows in the next 4 years of its remaining useful life, as shown below. As shown below. So you'll have here 2022, that is 2021, 2022, 2023 and 2024. Cash flow, $100,000, $65,000, $50,000, $45,000. Additional information below that. Number one, additional information. Number one, the selling price of the equipment was shillings 248,000. The selling price of the equipment was shillings 248,000. However, shillings 48,000 would be incurred to sell the equipment. Shillings 48,000 would be incurred to sell the equipment. Number two, the cost of capital is 10%. The cost of capital is 10%, and the appropriate discount rates are as shown below. And the appropriate discount rates are as shown below. Year 1, 2, 3, 4. Discount rates for year 1, 2, 3, 4. So, unlike in financial management, in advanced financial reporting, the discount rates will be provided. They will be provided. Even if you don't know how to get the discount rates, they will be provided. So you have year 1, 2, 3, 4, 10% discount rate. Year 1 is 0.1981. Year 2 is 0.8264. Year 3 is 0.7513. And year 4 is 0.6830. So those are the relevant discount rates. Required. Part A, recoverable amount. Part B, impairment loss, if any. Part B, impairment loss, if any. So it's not a must that the asset has impaired. Sometimes you might find that the asset has not suffered impairment. So solution. We'll have year, we'll have cash flow, we'll have the discount factor, and we'll have the present value. We have a further expected life of 4 years, with cash flows running as follows: 100,000, 65,000, 50,000, and 45,000. 100,000, 65,000, 50, and 45,000 for year 1, 2, 3, and 4 respectively. The discount factor has been given 0.9091, 0.8264, 0.7513, and 0.6830. I now want us to get the present value. I now want us to get the present value of the asset. Take out your calculator. 100,000 times 0.9091. This gives me 9910. Year 2, 65,000 times 0.8264. It gives me 53,716. Year 3, 50,000 times 0.7513. It gives me 37,565. Year 4, 45,000 times 0.6830. It gives me 3735. And therefore, the total present value, which represents what we are calling the value in use, will be, we add these present values together. Let's do that. This gives me 212,926. This is now our value in use. This is our value in use. Therefore, we compare this value in use with the net realizable value. Net realizable value. We know that this asset is expected to be sold in an open market at shillings 248,000. But to put this asset in a sellable condition, it will incur a selling cost of 48,000. And therefore, we can say that our net realizable value is 248,000 less cost to sale of 48,000, which gives us 200,000. Now, to get our recoverable amount, if you refer to our notes, we have just said that recoverable amount is the higher of the net realizable value and the value in use. Therefore, we'll compare the value in use of 212,926 and a net realizable value of 200,000 and a value in use of 212,926 and take the higher. Therefore, the solution to our first part of the question, the recoverable amount, you take the higher, and in this case, the higher, which represents the recoverable amount, is shillings 212,926. And ladies and gentlemen, that's how we determine the recoverable amount of an asset. Now, there is a second part of the question which requires us to determine the impairment loss, if any, on the asset. Therefore, you write below that second part of the solution, which is impairment loss of the asset. It is not a must that the asset has suffered impairment, and therefore we say impairment loss is equal to, this is our second part of solution, is given by the carrying amount of the asset It is given by the carrying amount of the asset minus its recoverable amount. We said from our introduction part of the topic that carrying amount is simply the net book value of an asset, which is cost minus accumulated depreciation. We know that the cost of this asset is 500,000. It is 500,000, and the accumulated depreciation, carrying amount, and the accumulated depreciation is 280,000. So the carrying amount will be 500,000 minus 280,000 to come up with a recoverable with a carrying amount of 220,000. Now, that's the carrying amount. But remember, the formula says impairment loss is carrying amount minus recoverable amount. Therefore, we can conclude and say that our impairment loss will be the carrying amount of 220,000 minus the higher of the value in use and the net realizable value, which represents our recoverable amount of 212,926. And therefore, our impairment loss will be, once I work it out, 7,074 shillings. Therefore, our impairment loss is 7074. So that is how you determine the impairment loss of an asset. On the assumption that the carrying amount would have been lower than the recoverable amount, you just comment and say no impairment loss has occurred. In case the recoverable amount is higher than the carrying amount, you should comment and say that no impairment loss has occurred.